Hi, this is Andy from Two Gray Beards,
And Nick, I'm back in the office after a short holiday.
and we'll get back on our regular schedule of Saturday episodes this coming Saturday. We're filling in this week just to get you on schedule and to mention that not much has changed. What has, I think, been the news? So, first, we'll talk about what happened last week. Resolution of banks, still waiting for FDIC reform. And what I think was continued to be a major deleveraging of hedge funds and others that were betting on the Fed being higher for longer. And that pricing came out in a spectacular way to the point where at one point 100 basis points of cuts were expected over the course of the next year, and that has abated along with the fear around banks as time has just occurred. So I think that's the big news from since our last talk. We did an episode right after the FOMC, so we won't belabor the comments we made there. What do we think about going forward, Nick?
Yeah, it's in bonds, it's a very tough one to buy these yields or to think of them as even remotely attractive. We are really in no man's land in terms of data. And I think the only value add that we can give our subscribers here is to discuss what needs to happen or what we would need to see to feel comfortable that the Fed will turn or that it won't, that it'll keep on going. And certainly, I think that for the Fed to feel at all comfortable that it has got inflation under control, it not only needs a PCE number on this Friday, which is in line with the market, but it needs something more than that. It's going to need help from next week's data, and that's non-farm payroll. I think inflation, unless it starts dropping off the edge of a cliff, and there are absolutely no signs that I can see that that is happening, it's not going to be enough for the Fed to justify these rates that we have at the moment. We have twos at 4%, we have fives at 360, and we have 30s at 375.
You
Uh,
mean too
these
low?
rates these rates are just not attractive given what we know today. For them to become attractive, and unfortunately we'd have to pay more, we need both inflation and unemployment to start moving in the right direction. Otherwise, the Fed will just not justify them. And the point that a lot of people forget is that at the moment we have an inverted yield curve and we have very steep negative carry. So people are financing their positions close to 5%. And at the same time, they're buying instruments or they're being forced to buy instruments which are yielding at least 1% below, if not, in most cases, one and a quarter to 1.5% below. That can turn very quickly into something very ugly. Because let's assume that PCE comes out higher than expected on Friday. It's going to be a huge game of pass the hot potato. Who wants bonds? Well, nobody, because they're all financing them 1.25% on average above, uh, below rather where they're buying them. So the move on Friday, if PCE is bad and inflation is still strong, is going to be quite violent, especially in the short end, in twos and fives. So really, those are not attractive at all. And I don't think that you need to even think about buying them now until we've seen not only this week's data, but also the non-farm payroll next week.
Right, I agree. And it's interesting, we're talking about the weeks going forward and the data, and it's also unclear to me that we've had, call it 2 months now of fairly strong data. Prior to that, we had 2 months of fairly weak data. And it's going to be interesting to see the market's reaction to weak data if they'll actually believe it, and the idea is that if the data is adequately weak, the Fed has stopped hiking interest rates and we're heading toward a recession. The question is whether that's believed. Currently, it's priced by the bond market. So you don't even win with bonds if the economy ends up being weak. So it's just an interesting thing about how believable weak data will be. Strong data, I agree, is going to have a asymmetric reaction, and that long term bonds across the curve, but particularly twos and fives, are going to go up in yield quite a bit. What do you think about
Absolutely.
equities?
Equities are really tough. We can see what is going on, deleveraging on the banking crisis, re-leveraging today with Nasdaq going down, with the bonds, while they are buying the Dow components that they sold earlier and the banking stocks, which boosts the Russell. Basically, it's all rotation, rotation, rotation. There is no direction whatsoever in equities. And I think that that is likely to persist for quite a while until we get some definitive data on the real economy. And the real economy either is going to roar ahead like it did in 98 after long term capital management, when the Fed panicked for no reason, but they're not panicking, it seems to me now. But it's going to take more and more data. And that is why I think at the moment, selling puts in equities at the right price, which we can discuss, is probably the only trade you can do to enhance the value of your portfolio, because equities are not cheap. And that is
No.
why in fact, they're damn expensive. And that is why we are not leveraging up on our equity portfolio. We are waiting for the whatever it is that is going to make them reprice to a sensible level. And in the meantime, all we can do is sell some puts at the levels where we would like to buy them.
Yeah, I agree. And I think for the next couple of weeks, unless the data does come in quite bad, the next couple of weeks down 4 to 5% seems like a reasonable entry we sold our equities. We went to minimum allocation last week,
Yeah.
into a good rally. And now we have an opportunity to add back to not a aggressive allocation, I would think, but to at least a neutral allocation.
Yeah, we're about 23% in equities, 24. If we boosted that up to into the high 30s, if we got exercised, I wouldn't, at the level that I want them, I really wouldn't be, sorry about that.
What
In
are you
fact,
thinking in terms of level?
yeah, well, I will discuss that in my segment. I've got some levels on my chart that I will go through, and I'll put the order in, so people can follow it if they like.
But you're
But
thinking somewhere in the, I don't know, 3800s or below.
somewhere in the very low 3800s, I have some particular levels in mind that I'll discuss.
Okay, sounds great. And in terms of the balance of the portfolio and what to watch, we have a fairly decent allocation in gold, which has done well for us. Gave back a little bit today, but with the broader deleveraging, um, I don't see any particular reason to change that.
No, in fact, I will discuss in my little segment certain levels where I think adding to gold makes a lot of sense,
But
where
the
the risk
options
reward
premiums aren't
at the
aren't high
moment
enough
it's
to
not
do
good
it.
enough, and I think we have time and we can cover it. We can cover a buy, an addition of gold potentially on Saturday
Okay.
if the pricing is attractive. At the moment, there's not a lot to do there, but I'll cover that in my section later.
And so, if the economy does roll over, commodities were definitely impacted by this deleveraging. Spot oil fell and has now recovered. Um, But if the economy does turn over and we end up getting hit on our puts on the equity market, I assume at some level we're going to get interested in buying more commodities. But at this point, we're underweight, and I think that's probably the right thing.
Yeah, I mean, and that's the other reason why I can't see equities doing very much this week, because it's very unlikely that oil goes up 5% and the economy, sort of rolls over in the same week.
Right.
So we have time, and we are invested in cash yielding near 5% with these FRNs resetting every 2 weeks.
Yep.
Uh, why throw away that optionality now without the data? I don't see the sense of it.
Do you have any insight on, because this is going to air tomorrow, probably the night before the auctions tomorrow. Today we had a very bad 2-year auction. What do you think about, is there anything to pay attention for our subscribers to pay attention to to the supply and demand of treasuries at this stage?
Not really. The market is still very skittish because, as we discussed, we are at levels which make no sense unless the Fed is going to turn.
Right.
And the Fed won't turn without data, and we don't have the data. So the market is very skittish that any supply it backs up.
Yeah.
I'd be very surprised if the fives and sevens went well. I
Right.
would not, I would, there could always be a central bank that comes in and needs them, but I don't think the market is going to move very far better on these auctions. I don't think they're going to go well. In fact, if anything, I would bet against them rather than
Right.
in
And it
favor.
just speaks to how, whether it's us or any investor at this stage, given the move that's happened in the front of the yield curve, um, buying bonds just anywhere in that space from twos to sevens just doesn't make sense. So we're going to pass, and we'll see after the PCE data if that was uh, only if that's extremely weak, and then that's followed up by another extremely weak number a week from then. Do I think it makes sense for us to lever up our bond position?
I think the only message that and the only value add we can give here to our subscribers is that for the Fed to change its mind and to actually not be higher for longer, it needs both the real economy and inflation to start turning from where they are. And we are only going to get data on one of those this week. And for a massive move to happen in bonds, we need data in both.
I agree. Okay, well, thanks for joining us again. I'll sign off, and Nick will lead us through the portfolio. Thanks, Nick, and thank you all. We'll see you next week.
So this is the level that I like in SPY, this 380. As you can see on a weekly chart, it's very much supported by the Bollinger Bands, and there's absolutely very little chance that we stay below it. And if we do, we don't go very far. We go down to 372 before we bounce again. So I reckon for the next 2 weeks, that level is safe, and I'll put the order in now. And here is the order. We're selling the 380 puts to the 6th of April. Why the 6th of April? Because it's the day before non-farm payroll. And then we can decide what we do or want to do after non-farm payroll, which is on the 7th. It's not going to make us a fortune, but it's going to enhance our liquidity, I'm sure. And as I showed you earlier, we certainly want them at that level. If we look through the Excel file, we can see the allocations where we are. We're not adding anything really, and even if we were to be exercised on that one option share, we would go up to about 39% in equities. Just to remind you, I've updated the chart pack so you can see that level in SPY that I'm looking at as attractive. I'm not updating the broker statement because it's identical to the one from the 23rd. There have been absolutely no changes. I'll update that on Saturday. And here is the order entry, as we showed you, selling one of the 380 puts, expiry April the 6th. That's all I have for you. Thank you very much.